first panel is measuring and regulating contingent risks, and each of the panelists is going to give a 10 to 12 minute remarks, and then we're going to have some prepared questions and then questions from the audience. So our panel from your right to left, is Andy Lowe, who in this building I don't think needs an introduction. He's a professor of finance here and director of the Laboratory for Financial Engineering here at Sloan. Bill Nelson is the executive vice president and chief economist of the Bank Policy Institute, but you can trust him because like me, he got his PhD at Yale and worked for many years in the Federal Reserve System. And then finally, Matt Richardson, the professor of economics in the finance department at Stern at NYU, and somehow managed to produce a book called SVB and Beyond. And they actually did write it after the SVB crisis. So without further ado, I'm going to turn it over to Andy, and then to Bill, and then Matt.
Well, so I'd like to start by thanking Paul for chairing the session and getting us together to talk about these issues, and Debbie and Ed for organizing this event. And it's a very important milestone this year, being the 10th anniversary of the Golub Center. And thanks to Ben and Bernie and others for basically creating this forum. I'm probably the least knowledgeable about the banking system, both on this panel and in this room. There are a number of experts, including Jeremy, who's sort of in the midst of, has been in the midst of it, Peter and others. So I guess maybe I'll start my comments by focusing on a couple of things, which is one, the analytics of systemic risk. What do we know? What have we measured about it? And secondly, specifically about systemic risk in the banking sector from an outsider's perspective over the course of the last 12 months. Because as some of you know, much of my recent focus has been actually not in banking, but in biotech and healthcare. And so I watched the SVB situation unfold literally minute by minute in the first couple of weeks of March, because a number of the biotech companies that I was advising had all of their assets at SVB to the tune of several $100 million. And they were in the midst of transferring it and figuring out what to do when all hell broke loose. So I'll just say a few words about that as well. From the measurement point of view, I feel that we're still not capturing the key aspects of systemic risk. And I say this with great respect for what the OFR, for example, has accomplished. I looked at the index today, the financial stability or financial stress index of the OFR, and it measured as of September 4th, minus 0.99. Now, you might not know what that means, but you'd have to go on their website and look at the record. And what that tells us is that we're actually below average in terms of our stress levels. So that should give everybody comfort here, right? Yeah, it didn't give me much comfort. And I wanted to know why. And what I concluded is that I don't think we're actually measuring what we really care about with regard to stress, particularly in the banking sector. And they've got some more refined measures of GSIBs and the kind of stress bank by bank, in fact. But ultimately, it seems like what we need to capture is the combination of the bank financial situation and the level of trust that counterparties have for those institutions. And it's the latter measure that I don't think we're capturing. I think yesterday's panel on in the celebration of the 50th anniversary of Black-Scholes-Merton, Peter Fisher made a really important point that I think is obvious to those of you who are in the banking sector, but may not be so obvious to those of us who are outside of it. And that is that bank runs are not about capital. That once counterparties decide to make a run on any financial institution, never mind banks, but any organization, there's no amount of capital that can stop that train. And if that's the case, then how do we deal with bank runs? How do we deal with this systemic risk? And I think it has to do with understanding a bit about the nature of human behavior. And I don't know that we're modeling that. How do you model the level of trust for financial institutions? I think there are ways of capturing that. In May's testimony of Gregory Becker, the former CEO of SVB, I didn't watch the whole thing, but I read some of the transcripts. He put the blame partly on social media. And for a bank executive to blame social media, it seems like that's a really big transition from how we think about systemic risk in banks. And oddly enough, I don't think he's wrong, but what he's capturing is human behavior. And so with regard to metrics, I think we do need to spend more time thinking more carefully about how we model trust and confidence in the financial system, and in particular in financial institutions. That to me would be a more useful measure than looking at capitalization rates and deposit and loan to value ratios, because those really don't capture the notion of what we're thinking about now as crises, bank runs, and how to address them. So the second set of points I want to make have to do with what happened in March with SVB. So as part of that Senate testimony, Mr. Becker was asked what he would do differently in terms of managing SVB over the course of the previous year. And inexplicably, maybe it was for legal reasons, he said he couldn't think of anything, that he would do the same thing all over again, which I just kind of found shocking. Now, clearly interest rate risk was a key component of what happened at SVB, but it wasn't the only component. It was also the fact that they had a very concentrated set of depositors that were from this, startup and venture capital world. And as I mentioned, I've been part of that world for the last several years. What happened in early March was that a number of the venture capitalists who were invested in the biotech companies that did their banking at SVB, and they were required to do their banking at SVB as part of their IPOs and their funding, they were told by their VC investors, SVB is under stress. You might want to think about moving some of your assets. And there were biotech companies that had done IPOs a few months before that had literally the entire set of proceeds from their IPO, 50 million, 100 million, 25 million, in SVB accounts. And they were told by their investors, I think you ought to consider moving those assets, which is what happened. And the question is, can any financial institution withstand that kind of herd mentality? I don't think so. So was this something that could have been foreseen? I mean, I'm not a prop trader, but I know a number of people who are, and they've been telling me that SVB is an accident waiting to happen, and they'd seen it months before, particularly with interest rate risk, and particularly given what was going on with inflation. I don't think the Fed shocked the market with huge interest rate increases. I think that was well anticipated. And if you looked at inflation rates, it's pretty clear the writing was on the wall as to what monetary policy had to be. So the interest rate risk that SVB faced, it is a little hard to understand why they didn't hedge more actively. But again, as an outsider, as a non-expert in the banking sector, there may be other reasons for that. The point is that from the biotech sector's perspective, this was incredibly disruptive. And now that the government has stepped in to bail out the banks, it's not clear whether or not there's any further point to this FDIC deposit insurance, because it seems like all banks are too big to fail, regardless of their size. So I think that's a pretty significant sea change, and that's got some important policy consequences that I don't fully understand, but I'm hoping that the rest of this panel will. So I'm waiting to hear what the rest of my colleagues have to say. Thank you.
Thank you. Paul, thank you. Debbie, thank you. I really appreciate the invitation to be here. I anticipate learning a lot. Debbie asked me to come and speak about what my reflections on the failures, what the lessons are from them, what the regulatory implications are from them, both as my work as a regulator and as a representative of the regulated. Just quickly, by way of background, I'm the chief economist, as Paul mentioned, at the Bank Policy Institute. BPI is a research-focused trade representing the 40 largest banks, including GCFPs and regionals and foreign banks that have big operations in the US. Before that, I spent 24 years at the Federal Reserve in the Division of Monetary Affairs. There, among other things, I oversaw the Fed's regular and emergency lending, and I was also MA's liaison to supervision and regulation. And in that role, I was on the LISIC, which oversaw the supervision of the GCFPs, and I was on the CLAR, the steering committee of the CLAR, the horizontal liquidity review, and I spend a lot of time both in DC and in Basel working on developing the post-global financial crisis regulatory framework, especially the liquidity requirements as part of that. So I'm not going to go through why all the banks failed. I think this room is pretty familiar with that. And I'm going to focus particularly on SVB because that happens to be what I'm the most familiar with and have very similar perspectives to Andrew. So SVB failed because they made massive losses on their fixed rate securities. They had a large portfolio of treasuries and agency MBS. They were funded with unstable, uninsured deposits. When those depositors became concerned about the solvency of the institution, they ran. It's also important to recognize that SVB struggled at the end to get a discount window loan. They had $20 billion in collateral tied up at the FHLBs, $20 billion tied up at their correspondent that they weren't prepared to use, and the institution failed. So I'm going to talk about things that we learned and things that I think should be changed. So some of the things that we learned are things that I think we all knew, but we'd kind of forgotten and needed to relearn them. So when I teach my students at Georgetown about banks, the first thing I say is that the business of making loans and taking deposits is unstable. And that instability is addressed by deposit insurance, by access to the discount window, and by supervision and regulation. But SVB wasn't supported by the safety net. They didn't have deposit insurance, effectively. They weren't able to tap the discount window. And their supervisors seemed to be focused on process and other things rather than on clear risks to safety and soundness. One thing that those of us who teach and study finance know in our bones but haven't been very well able to convince the rest of the world about is that what matters is market values, not par values. A loss is a loss, whether it's from credit risk or from rising interest rates. Doesn't matter whether you realize it or not. If you realize it, you make the loss then. If you hold on to the asset, your profits are lower for over time, and the present value of those losses is the same. If your business plan requires that you hold on to the asset, that just means your liquidity risk is higher. Another lesson that we've relearned is that solvency and liquidity are intrinsically linked. Back in the the second half of the 1950s, when the Fed was evaluating the condition of a bank, they used, among other things, Form FR 363. That form established a risk-based capital requirement where risk was based on credit risk as well as interest rate risk. And in that form, they lined up your liabilities to see which ones were going to run, and then they lined up your assets to see which were going to be liquid. They came to a judgment about how much you might have to sell if you were under stress, and they valued those assets when calculating the institution's capital at liquidation value. So the last thing I'll mention that we relearned is that if you require banks to hold liquid assets in proportion to their liabilities, that's bad, not good for financial stability. And it's only the central bank that can fix that problem. So current liquidity requirements basically say you hold HQLA over your liabilities. They look a lot like reserve requirements. Well, the Fed was created largely because it was recognized that reserve requirements are bad for financial stability. In the panic of 1907, for example, a lot of banks closed their doors while they still had cash available because of reserve requirements. And the Fed was created to be able to step in to provide liquidity against the bank's commercial paper, that is against their short-term business loans. And that was its role. It made the banks genuinely more liquid. Now, there are some new things that we learned, or at least that I learned. One is that a deposit franchise isn't necessarily a very good hedge for longer term assets. So deposit rates are sluggish. When interest rates go up, they tend to fall behind interest rates. If you have a $10 billion deposit franchise with low yields, its market value might be worth, say, $8 billion. If you likewise hold $10 billion in fixed rate treasury securities whose value has fallen to $8 billion, it looks like you're well hedged. Your economic equity hasn't changed. But if you're a depositor, if you've deposited $1, you get back $1, you don't get back 80 cents. So if those depositors all run, you're no longer hedged. Suddenly you have a $2 billion uncovered loss. If you're insolvent, you don't have the assets actually to cover a run. So the depositors will run. It's not even a Diamond Digby Sunspot run. It's just a flat out, you can't repay me, I'm going to run. Another thing that I learned, I was really surprised by, is that the government, and I think probably is particularly relevant for the discussion in this room, is that the government is much more able to get around its own past efforts to tie its hands than I had expected. So responding to a financial crisis are painful, costly. The government may want to respond in ways that it itself dispassionately afterwards judge are actually more costly than the cost it would have incurred. And so time after time, the government has passed laws to commit itself to not do so again. So in the late 1980s, for example, Fed lending was seen as raising costs to the FDIC. And so the FDIC Improvement Act of 1991 limited the ability of the Fed to lend to troubled institutions. Well, recently, the Fed actually made new loans to the bridge banks of SVB and of Signature, loans that I think call into question, that seem contrary to at least the spirit of fiducia, if not the law. The Dodd-Frank Act required the Fed to have security to protect taxpayers against losses before making any new 13(3) emergency loans. Well, the Bank Term Funding Program, the program the Fed set up, was designed to make loans in excess of the collateral, the value of the collateral that it was taking, and it did so on the strength of a Treasury guarantee. Now, if you look at the Fed's letters, the Fed has to send letters to Congress to explain its 13(3) programs. If you look at the first letter, it said the Fed had taken these actions to protect taxpayers and to protect the Federal Reserve against losses, including all of these things, including, with no irony, the Treasury's guarantee of the program. Now, if you look at the subsequent letters, the one immediately after, it just says that those things protect the Fed against losses. So they dropped the bit about protecting taxpayers against losses. And then lastly, the Dodd-Frank Act also told the FDIC and the Fed and the Treasury that they could no longer use the systemic risk exception to provide a blanket guarantee of the liabilities of the banking system. So what happened? Well, after guaranteeing the uninsured depositors of SVB and Signature, the policymakers stood up and said, don't worry, if any other subsequent banks fail, we will, on a case-by-case basis, guarantee the uninsured depositors of those banks. Voila, no congressional authorization required. There's at least one lesson that was learned that I think is incorrect, and that's that the tailoring imposed by Congress and by the banking agencies contributed importantly to SVB's failure. And so here I'm disagreeing with the Barr report, but I'm agreeing with at least Chapter 4 of the NYU Stern report, excellent report that Matthew and colleagues wrote. So consider liquidity. SVB was required to conduct quarterly internal liquidity stress tests. Banks tell us, because their examiners make it so, that the internal liquidity stress tests are at least as tough as the LCR. The tailoring did free up SVB from having to comply with, to do monthly tests and to be subject to the LCR and the NSFR. But SVB was awash in liquid assets. 58% of their assets were HQLA. They could have easily passed the NSFR. To pass the LCR, they would have needed $8 billion more HQLA, but they could have gotten that without changing their business model or their size, simply by deflecting some of their investments over time into Ginnie Mae's, which are level 1 HQLA, and away from Fannie and Freddie's, which are level 2A HQLA, and so are subject to a haircut and a limit. Moreover, the SVB was failing their internal liquidity stress tests. The system was working, but examiners were inexplicably didn't take action. Regarding capital, tailoring basically did two things. First of all, SVB was not able to benefit was able to benefit from what's called the AOCI filter, which basically means that their losses on their available for sale securities were not counted in their regulatory capital. But if those losses are included, you can just calculate it. Their CET1 ratio would have been 10%, well above the 7% requirement. And the other major thing is that they weren't subject to the stress tests. But the stress tests are designed to replicate a recession. They generate credit losses. SVB had a portfolio of government securities. They wouldn't have made many losses. Moreover, interest rates go down in the tests. But even if interest rates had gone up, and even if SVB had not been subject to the AOCI filter, it would have done fine in the stress test. Why? Because 80% of its securities were held to maturity. Held to maturity securities for everybody are valued at par, and so don't go down in the stress test, even if there's an interest rate up scenario. So in light of these lessons, what are some of the changes that I think should be made? So on June 9th, BPI published a set of recommendations after working with our member banks for things that should be changed. And those included some tightening of regulation and supervision, and also some suggestions on how the Federal Reserve and the supervisors should change what they do. For recognizing the role of capital losses, we recommended that the AOCI filter not be available only to a smaller set of institutions, that more and smaller institutions not be able to take advantage of it, and also that banks' ability to shift securities into held to maturity as a consequence be limited. And we also recommended that the Fed include an interest rate up scenario in their stress tests. Regarding the important role of concentrated correlated deposits in their risk, there is no guidance on that now. So we recommended that examiners issue guidance on concentration of deposits and collect whatever additional data is needed in order to do that. Now also, and this is the part that's most near and dear to my heart and my work, we recommended that any recalibration of deposit outflows be done as part of a comprehensive review of liquidity requirements. Now, BPI had actually called for such a review on February 23rd, 2 weeks before the failures happened. We pointed out that during the global financial crisis, there had been a sea change in how the assessment of a bank's liquidity had happened. Before the global financial crisis, liquidity was assessed by the ability of a bank to have reliable and diversified funding, and including the contingency funding, and being well able to access the discount window. After the global financial crisis, liquidity was measured by the bank's ability to have a big pile of HQLA, and the discount window was to be shunned. Well, what happened? SVB had a big pile of HQLA assets. They had correlated and undiversified, unreliable funding, and they weren't able to access the discount window, and they failed. So what we suggest is that the ability of a bank, and this is something that I was suggesting within the Fed, Jeremy can attest to this since 2010 or so, that the ability of a bank to tap the discount window be recognized as a source of liquidity. So just to tell a story about SVB. SVB was interested, they were failing, ILSTs require banks to be able to convert their assets into cash. SVB was failing that requirement. They were interested in signing up for the Fed's new standing repo facility, but when they asked about it, they were told that that would not give them any examination credit or the discount window. Their monetization couldn't include using the standing repo facility or the discount window, so they didn't sign up. Now, what we're suggesting is similar to Mervyn King's proposal. Just a couple more things that you might be familiar with, except it's more modest. So let me ask, I'll end there. I seem to be out of time. So I'll stop there. Happy to answer any questions on these recommendations. And all of this is published, so I'm glad to send any work if you want.
Okay. Matt brought slides.
I did bring slides. Debbie asked, actually not me, she asked Viral Acharya, my better half, but he was speaking at the Fed today. So she asked me to talk about NYU's kind of systemic risk measures and what they told us about the banking system sort of prior to the crisis, which is a bit of a counterweight to Andy. That's actually the book. You can get it on Amazon, but it's actually free from our website. So it's an ebook. 10 faculty were involved. We actually didn't work on it before the crisis, but we did actually work on it the weekend of the SVB failure. It was 10 faculty. You know, NYU Stern has a lot of banking experts. I'm not one of them. So it's got a lot of different opinions. So it's it's good reading if you're interested in the topic. So systemic risk. So what is it? So from a 30,000 feet down, it's sort of whether an institutional failure kind of has knock-on effects for the real economy. Obviously, that failure is much more worrisome when the sector is weak, right? When the sector's struggling and you fail, that has a bigger impact. Using that kind of like background, like 15 years ago now, after the global financial crisis, a bunch of us, wrote some simple theory that sort of had some built-in externalities as assumptions. And then given those externalities, we ended up with sort of measures of systemic risk. The big result that came out of the paper was that a firm's systemic risk was proportional to its contribution to an aggregate capital shortfall in the system. A few years later, we extended it to runnable liabilities because we were talking about insurance companies versus banks. So runnable liabilities gave a kind of kicker to the risk. And we had this sort of central planner. The optimal thing was a kind of a systemic risk tax. If you didn't do that, then obviously you end up with too much risk, too much leverage, too much runnable debt kind of in the system. So that was sort of the framework. So we have these measures. They're available. They've been really almost since the global financial crisis. They're available online. They're real time. It was part of the volatility lab, the VLab system at NYU Stern that Rob Engel set up to estimate conditional volatilities across the financial system. Then we added systemic risk as one option. We have like climate risk and a few other things now, liquidity risk on top of that. And what's nice about the measure is it does use market data. So it's real time, uses market data. So that's sort of maybe a little bit different than, looking at purely at accounting or book data. So that's sort of a nice feature of the system. The idea is you want to measure expected capital shortfall given a crisis. And so the way we implemented it was there was sort of a prudential level of capital. In a crisis, if equity falls below that, that would contribute to the aggregate capital shortfall. That's S-risk. S-risk uninsured is as a kicker with uninsured, with runnable debt. So as an example today, I'm showing something where we increase the prudential capital level based on uninsured deposits. Like if you have a lot of uninsured deposits, that's going to put more stress in the framework. Of course, the nice thing about the measuring the loss in equity in a crisis was because we have Rob Engel involved, we have, it's heavy statistics, and we have the key feature is we have a dynamic conditional beta that sort of helps, changes through time for different institutions, different banks, and it's based again on market data. So that's the system. So here's the first graph. So this is a graph of the S-risk with the uninsured kicker, so including uninsured deposits, and divided by the quasi-market value of the bank. So it's on a per dollar of asset basis. And this is what it looks like over the last 2 years. And we're looking here, we're looking here at banks between 100 to 250 billion of book assets. And I have this black dotted line here. You can see this black dotted line. That's actually March of 2022. That's the beginning of when you start seeing a pretty big drift in this measure of S-risk. And it actually doubles for a number of institutions over that year. And you see these two kind of guys up here that starts to go up in March 22. That's SVB and Signature Bank. And it's not rocket science, right? I've got to be careful not to laser Andy there. I might actually stand up. Not good to kill your co-panelists. So this is a chart from the FDIC, and this is 2022. And you can see there's a bunch of losses on its investment securities starting in 2022 across the banking sector. We know what that is. Interest rates spiked, you're long the bond market, you have investment losses. But maybe that's not a problem, as you mentioned, because there's this deposit franchise value. Interest rates go up, deposit rates are sticky, that spread increases, that adds value to the deposit franchise of the bank, and it's a natural hedge. And we have obviously co-authors of the book, Alexis Savov and Philip Schnabel, who that's a prime view in their minds of the banking system. But of course, that relies, as you mentioned, on deposits sticking. You can see here, for example, with SVB, it started to lose deposits in the first quarter of 2022. And it's probably the more extreme of all the banks here. But you can see it was losing deposits throughout that framework. And there's a number of banks that began to lose deposits at the end of 2022 as well. So interest rate losses, deposit franchise value eroding is a problem. And so that's what kind of shows up in the data. And that's why you sort of see it here in this S risk. We also looked at S risk without the uninsured deposits. So without uninsured deposits, it still shows that behavior. Sorry. Oops. It still shows that behavior. It's just the slope isn't as steep. So it's more dramatic for the firms that have a big chunk of uninsured deposits in their system. Interestingly, when you do the same analysis for banks between 50 to 100 billion, you don't see it so much. So for some reason, it was kind of concentrated in that kind of large mid-size bank range. And that's discussed a little bit in the book. We've done, we look at October 22, what's a systemic risk measure of the banking system, different measures using uninsured, using the general one, looking at the components, leverage, the expected loss in equity. And then we have this thing called stressed equity, which looks at debt over equity in condition on a crisis. And what you see this negative slope. So this is looking at a regression of price changes, realized price changes from November through March using the October systemic risk measure. The reason why that's a relevant analysis is because the systemic risk measure is conditioned on a crisis. We kind of know we were in a crisis in this period, so that's sort of a way of evaluating whether there's kind of a loading on those measures. And it looks like there is. It's negative, and it's especially strong for this stressed leverage ratio. When you look at stock returns, there's a lot of idiosyncratic risk. So we take quantiles and buckets of them, and then we sort of, not a ton of data, so that's why we graph it. You take the quantile, you take the average equity loss, you regress it on the sort of average stress leverage ratio, and you sort of see these negative slopes showing up and pretty high R-squareds in terms of future price changes based on that measure using market data. And then just to conclude, maybe just a couple of comments on the insights from the data and the theory. And I think some of this actually came up yesterday in the panel on contingent claims with Debbie and Peter. First of all, risk is just not credit risk, right? So it's what's the aggregate market risks out there? And, in an inflationary environment, which 2022 was, running stress tests without some, inflation component is a little bit of a head scratcher, right? We understand you want to look at severe recessions, and severe recessions usually have low interest rates, but we weren't in a low interest rate environment. So that's a little bit of a puzzler that has to probably be improved. Capital liquidity, what this data shows is that they're linked together. Like you get much more power when you look at you could have something that didn't have a liquidity problem, but had a little bit of a capital problem, not so bad. Had liquidity with no capital problem, not so bad. But those two together really sort of compounds, and that's what the data shows. And then the other thing which we showed back 15 years ago is there's this obsession with large banks, and I understand it because they're complicated and they need to be looked at carefully. But the theory says risk aggregates up. So if you have like 5 large mid-sized banks and 1 large bank, and they have the same number of assets, then it's a horse race based on sort of the leverage, the riskiness of the assets, the runnable liabilities in these measures. So it's not clear that capital liquidity should be focused on those big banks if a lot of large mid-sized banks have even bigger problems. And we did an exercise from 2008, in 2008, where we looked at Wells Fargo, which was at the time a relatively safe large bank that was subject to a lot of new regulation. We did in 2010 in Dodd-Frank, et cetera. And then we looked at some of the large banks in the regional banking sector that operated in the same areas that Wells Fargo did. And they showed up as more systemically risky in our measure. So that's one thing to think about. It's just not size. It's the actual underlying capital liquidity risk. Thank you.
You're welcome. We're
Really interesting.
thank you guys for those excellent remarks. So I have some questions prepared, and actually, let me start with you, Andy. You're on. And I'm actually, I had prepared it, but you actually kind of queued it up. I mean, when you said that we have this kind of intuitive sense of how risky the banking system is now, and then there's the OFR's measure, and that the OFR's measure obviously isn't capturing something that you can see or you can sense. And so I'm going to put you on the spot and say, since I know this is something you have studied, isn't that kind of what AI is supposed to do? Is supposed to capture that more broad sense. Is that something it can do?
Well, yeah, I think it can. And that's why I said that the comment Gregory Becker made about social media is not totally crazy. But I think I would have put it a little bit differently. I think that we need to measure depositor sentiment in some way. And we have to do it in real time. Now, I don't know too many bank executives or biotech VCs that use TikTok, for example. And I'm not sure TikTok's the right social media venue. But we do have enormous amounts of data out there now. And I don't know that we're using it in a way that is most helpful for identifying these kinds of behavioral patterns. You know, some of the work that Matt and Rob Engel have done, I think, captures that to some degree. Obviously, using market values makes sense. You know, credit default swaps is certainly, you know, a good indicator of stress. But I think if we were to try to replay events with SVB and get a sense of what was going on in the biotech venture capital community and the nervousness that the VCs had and how they spread that to their portfolio companies, that's something that could and should have been measured. And I'm not sure exactly what the data sources are, but there are enough data sources, particularly in the venture capital community, where they share information across these different investors, that their lack of confidence or eroding confidence in SVB and First Republic and some of the other banks that were involved, I think that's something that could have been measured. The more difficult question is, what do you do about it? And I'm not an expert. You know, one of the things that Bill pointed out was about supervisory issues. And I've also looked into what happened at the San Francisco Fed, you know, in the aftermath. They did a lot of soul searching. They pointed a lot of fingers, you know, claiming that they had actually provided information to SVB as early as 12 months before this event, that they needed to raise more capital. But I have also heard that supervisors are loath to impose any strong measures for the banks that they supervise, because they fear the very thing that they're trying to prevent, which is they don't want to cause a run. So I don't really know how to walk that fine line. Maybe it's something that's a bit more than just supervisory issues. A few years ago, Jeremy Bulow and Paul Klemperer at Stanford put out a publication that was based upon a memo that they'd written with Jacob Goldfield, suggesting that banks use a different form of debt, what they call equity recourse notes, which are countercyclical instruments where if banks are not able to meet their obligations, it automatically converts to equity at some pre-specified ratio, making it less likely that banks would fail. I don't know if that's the answer. I don't even know if from a regulatory legal perspective whether that's even feasible, but it seems like that may be the ultimate solution here. We can come up with all sorts of measures, and we may even be able to measure these kinds of panics and using social media. But at the end of the day, when you have these measures, somebody has to do something with it. And if you're relying on human intervention, that may be the problem, the binding constraint. We may need to have some kind of automatic stabilizers that will just reduce the chances that you need human intervention. And again, I'm no expert in banking, but I believe that the experts do have proposals for how to create these automatic stabilizers.
Thank you, Andy. So, Bill, I'm going to turn to you now.
Okay.
And ask you the question, if you were a depositor today, should you worry about uninsured deposits anymore, or have we basically given up on that it's no longer a credible threat?
So it's an important question. If the government has effectively guaranteed all deposits, then public policy should take that into account. I'm not, well, so it's a tough question too, actually. I think that that's a tough, in some sense, the problem may well have been may be solved as we're sitting here by IntraFi. As you guys probably all know, there's if you have a massive deposit, you can go to IntraFi and they will spread it out around the banking system so that all of it is insured. This is huge. So effectively, whether the government has changed anything or not, a lot of deposits actually are being insured. It's also important to recognize that to raise the deposit insurance limit, you need to change the law. And it's just not clear that the current Congress is going to be able to change any laws or make any changes. Like Andy, I at least have one friend in the Silicon Valley venture capital business. He's a good friend. Several years ago, he called me. I was just chatting with him, and he said he had these millions and millions of dollars in the local credit union. And my eyes popped out, and I was like, well, he says, what do you mean, credit unions can fail? And I said, they can fail, that you're not insured. So lo and behold, I get a call in March from him saying, what should I do? I moved all my money from the credit union into Silicon Valley Bank. And I said, it's not insured. He said, it's not insured. He said, they should put signs on the door that say there's a limit to deposit. And as I sent him an image of the signs they put on the door that say there's a limit. People laugh at me when I say this, but I honestly think that there's a lot of confusion over this. I don't think that a deposit above $250,000 should be called a deposit. I actually think it would help a lot if it were called something like an at-risk investment, and forcing banks and forcing people to recognize that you're making an unsecured investment in a financial institution.
So you don't have more than $250,000 you don't personally have. You've. That's right. Okay. Yeah. Because often with economists, you have something where you tell some story like this, and then you're like, well, yeah, then I realize that I did. And actually, this is a dumb question, but it is. So my account. Why aren't they just invested in? Why do you have a deposit account? Other than the fact that at SVB you were required to. A lot of the people who I talked to had accounts weren't required to, and they weren't using the money. In other words, money was just sitting there. Why don't they invest it in
money market mutual fund?
Yeah.
Well, my view is, I think you're still asking me.
Yep.
I think that important part of what happened was that during the post-COVID crisis, all interest rates were down at zero, and so the opportunity cost, deposits were actually quite attractively priced compared to normal. The opportunity cost of just leaving your money on deposit at your financial institution was effectively zero, and a lot of people chose to do that because it was convenient to do so. And banks are very well capitalized and very safe. It's true these banks failed, but nevertheless, it's most the vast majority of banks are fine. So that I just think that it was a matter of, at that point, people became they just didn't really care.
Okay, so Matt, I'm going to ask you one question, and then we'll turn to the audience,
Okay.
which is, basically, we had a huge policy reversal at the Federal Reserve. We went from saying that interest rates were going to be zero in 2023 to very quickly to high rates. Are you surprised that, and that meant long-term bond values collapsed, with all these things? Are you surprised that the damage wasn't worse, first of all? And given where we were in March, are you surprised that it seems to be out of the headlines and not something people are that worried about now?
Okay, so maybe a couple of points. First of all, in the last 45 years, we've had only 2 periods of runaway inflation. That was recently and then in the late 70s. Both of them led to banking. I don't know if I'm saying this is a banking crisis, but both led to huge banking stresses associated with interest rate losses. So, and an erosion of the deposit franchise business that was same in the 80s at the S&Ls, and it's the same today. So that shouldn't be a surprise that I think that there was this, once inflation looked like it was permanent, as Andy said, obviously rates are going to have to reflect that, and we get a hit to those institutions. Those, they're still there, right? They're still facing interest rate risk. And so in that sense, banking crises aren't like weekly events. They linger. Like the S&L crisis lasted for years, right? The global financial crisis lasted for a long time. In continental Illinois wasn't a weekly, that lasted for a long time. So this is going to last for a long time. And there are a lot of shoes to drop. I mean, think of the commercial real estate sector. Think of the office space subsector of commercial real estate. We all know in this room that is not coming back anytime soon. Someone is bearing those losses. A few hedge funds that I know that invested in that business, they've already dumped it. They've written it off to like zero. So there are institutions out there that are saying so obviously the banking sector, regional banking sector, is involved in some degree in that area. I'm sure supervisors are frantically, looking over those books. So we aren't out of it yet. I think the fact that, it's not in the press, that same thing happened in the summer of 2007. We kind of forgot about it a little bit. Bear Stearns occurred in March 2008. We kind of forgot about that a little bit, and then something happened. So it's a worry. It may not come to fruition, but I think that, it's surprising. I don't know what's in that OFR thing, but I don't know. Our measures show there's a fair amount of risk in the system, and we know commercial real estate is super fragile. We know interest rate risk is out there. I don't know. It's a pretty scary period. And you talk to banking executives. I know a few. They say it's a scary time, especially in the commercial side, because the demand for credit is really weakening. So I don't know. So my answer is this.
Too soon to tell.
Too soon to tell for sure, I think. Yeah, not to be too negative, but.
Good. So it's the fall of 2007.
Well, I'm just saying it's it's not you know more than I do, but it's there are a lot of risks out there.
Okay, so we're ready to take questions on the floor. Bob.
Book.
Yeah.
You showed everything, the risk going to the moon, right?
Increasing.
How much of that is being driven by the fact that your models use the market price of the stock as the input. In other words, if we reran all the other elements, but took that out, would you have gotten the same picture?
Yeah, so that was the point, that if you looked at the difference between the S risk uninsured and the S risk really is very much focused on the expected loss in equity given a crisis. And that depends really much on the conditional beta, which has gone way up. So those losses are bigger. And it's just as like the banks that had uninsured deposits also had that equity loss problem. So that's why it's a steeper slope. So it's driven by the market data, which is equity. Equity data is driving it, you know, if that's your question.
As a quick follow-up then, we had various discussions of how to measure things, looking at social media, doing all these things. God bless. How much would you have picked up just using market prices of the equity, your model of signals that you saw? Do you see what I'm trying to get at?
Yeah.
That you know, the nice things about markets is they aggregate all that information instead of telling individual scenarios about someone has a, you know, a social, psychological, whatever. You see what I mean? So I'm really just, as a practical matter, and I don't want to extend this question, but since you put it up there, it looked pretty interesting to me.
Yeah,
anyway.
it's mainly driven by market prices, but it's driven by the co-movement of these bank stocks and the aggregate sector. So that was becoming higher, you know, during that period. And that's a problem because if you get hit by a big shock, you know, then you've got a big loss. So it's, and that could take into account social media, right? As you said. Yeah.
Then I can't resist, and you don't have to even answer it, but I want to ask it. Why is it, if it's not being done, that the regulatory authorities, as a routine matter, instead of trying to measure capital if it's enough or something, which they can do too, I'm not saying as a substitute, why don't they have, if they don't, the market prices of all these shares in there? Because these pick up things very rapidly without having to explain which element is doing what. I mean, that's just a general question.
So of course they do.
The Fed does.
They do all that. They do that. And
the Fed actually uses our thing. I mean, they look at it.
They also include in their supervisory material the asset prices of the institution. And it's also probably important to recognize that something like 95% of the equity analysts out there, before SVB's troubles began, were recommending that the institution as a buy. Moreover, and to go back to Andrew's point, the option price on interest rates going up as much as they did, if you look back before the rise in interest rates, and I did this because I've done a lot of work on Fed profits, was basically zero. So I agree with you. I mean, those would all be great things to do. Incorporating sub-debt into those would all be great things to do, but it's not a panacea.
And if I could add one thing, I mean, this is to the conference yesterday. If you looked at implied volatility of these banking institutions, it looks very similar to that S-risk graphs we showed.
See, what I was just getting at, I'm sorry. When you say you look at the value of the assets, are you looking at the assets on their books, or are you looking at the market price of SVB stock?
Stock, debt spreads, all of those things are monitored.
Okay.
They are monitored.
I see. And
So you know, the thing to keep in mind is that in the case of SVB, it's in the public domain that, you know, several weeks before the event that triggered the failure, they were already in discussions with rating agencies about the fact that they were going to get downgraded. And so there were all sorts of indicators that they're having difficulties. But getting back to Peter Fisher's point from yesterday, capital is not going to stop a run. And I think that's the issue that I keep coming back to. There was a call that Gregory Becker did with investors. I think it was March 7th or 8th. I don't remember the timing, but I was on that call. And what he said was, we're fine. We're raising more capital. We've got a very strong balance sheet. The only problem we would ever face is if you lost confidence and pulled out now. This is the bank CEO saying this to a group of investors. As soon as I heard that, I told our biotech companies, get out of SVB. Because what does he say? This is the bank executive telling the depositors that, you know, the only problem is if you leave, then we're going to have a problem. I mean, on the one hand, that's kind of obvious. It's, sort of to anybody who understands fractional reserve banking. But for him to say that on a call is probably not a good thing.
Yeah, I mean,
So Andrew, while capital isn't going to stop a run, insolvency or very, very low capital is certainly likely to spark a
right.
run.
And they were in the midst of raising capital. And had
Well,
they done
they failed.
so before they announced they were doing so, I think that would have.
I agree. I mean, never panic, but if you panic first.
Yeah,
right? And so,
exactly. Exactly. So that's why I was a little surprised when he said to the Senate committee, I don't know. I don't know what we do differently.
If you mark their books to market, their equity was zero. So I think that had a lot to do why the run happened.
Eric?
My question's for Bill. Good to see you. So you're an expert on the discount window. And if you look at the financials of Silicon Valley Bank as of the end of the fourth quarter, their held to maturity losses exceeded their capital. So if you were the discount window officer at the San Francisco Fed, and given that we don't lend to insolvent institutions, would you have been willing to give them a loan after those financials were revealed? And the second part of the question is that normally the discount window works with the FDIC to close the institution once it's viewed that they will be equity insolvent. Do you think the spillover cost would have been substantially less if they'd been closed the weekend before?
Great to see you, Eric. Thank you. So, regarding the first question, you're sort of in effect saying, should we be evaluating banks with their held to maturity securities mark to market? And the fact is that that's not how supervision is done. As you know, there are financial soundness requirements for a bank to have access to primary credit. They're basically that it be CAMELS 3 rated or adequately capitalized. I don't know about its CAMELS rating. So I think that any discount officer would have followed the rules of the game as the rules of the game were written at that time and would have lent to the bank. I don't think that would have prevented SVB from failing. I don't think a discount window loan would have prevented SVB from failing. It's possible that if SVB had been willing to use, as many of you may know, on the 8th of March, SVB did two things. They sold their AFS securities, realizing the losses on those securities, and they attempted to raise capital and failed. And that's what really sparked the run. People that I know that were very involved in this believe that if SVB had, instead of selling their securities, been willing to use the discount window to raise funding to meet their funding needs at that time, because the decline in deposits was really the result of a decline in the industry, that they could well have gotten along a little longer. I would have thought that and they could have. I think the failure could have been more orderly and less costly. I'm not sure that any of this would have happened under those circumstances. The loans that they were trying to arrange on the day of the failure or the day before, those wouldn't have solved it, but they still might have provided enough confidence to get to the weekend to traditionally have a more orderly failure, which I think could have made a big difference. Signature was not book insolvent, not market value insolvent, for example. I kind of dodged your first question, I admit that. But with respect to the second question, I do think it could have really made a big difference. Traditionally, getting the bank to the end of the day, to the end of the weekend, so that the resolution can be done in an orderly manner is a traditional role of the discount window.
So there's legal requirements like capital requirements, liquidity requirements, and then there's supervisory authority. And what I heard you all respond is, oh no, the supervisors see all this market value data. But the fact is that those rules are never linked, haven't been linked to the market value data. And so I just wanted to hear, I know my personal opinion is that using the supervisory authority is messy for many reasons. It would be better. In fact, the capital would be more effective if it were more linked to economic reality. And we have all this great work which shows that economic reality is actually very predictive of true distress. So I just wonder if any of you want to comment on what you might do to the rules, not to what supervisors see, but if you've thought about linking capital requirements to this. I mean, the regulatory response to me was bizarre because it talked about things like liquidity requirements, and it never seemed to get to the root of the issue, which was we have no automatic protection against interest rate risk. Banks don't have to hold more capital when their interest rate risk goes up. That seems like a problem. So I just wondered if you could comment on that whole set of issues of what you would actually do to the regulations, not just the supervisory authority.
I think it's worth mentioning that there was a huge study done within the Federal Reserve. It's online, it's available, of the possibility of using sub-debt spreads as part of regulatory requirements and certainly as a regulatory tool. And the conclusion that was reached, and this was quite a while ago, was that there were just too many false positives. There were too many instances. Of course, spreads don't just respond to changes in the assessed loss. They also respond to liquidity problems and to changes in liquidity tolerance. And you have to, and that I think tends to be the problem when you try to do this. I mean, like probably all of you, I would love it if all bank regulations were linked to market value in some way that could work, because then it would take the government out of credit allocation. There's just all kinds of positive features about that. But when it's been looked at, it just hasn't been considered to be workable. But that study was done before TLAC, before there was a big growth in the market for banks' longer-term debt. So I would think that it deserves certainly another risk, more consideration. What Andy described in terms of the contingent equity sounds a lot like COCOs in Europe to me, I think, and that proved to be some challenges in invoking those as well with Credit Suisse, but I'm not an expert on that.
Yeah, so I think that Bulow and Klemper explained the difference between equity recourse notes and COCOs, and they claim that this deals with the failings of the COCOs in a more effective way. I don't remember the details, but I think it is worth another look. The other thing that I think, maybe Jeremy, you have a better perspective on this. I'll yield to you, but I think that we're going to need to make changes in bank accounting is at the bottom line, and then to create automatic stabilizers. I don't think it's changing regulations. I think it's changing the way that we actually think about how banks are capitalized and what the underlying legal structures are to make them automatically countercyclical.
If I could just add one thing before Jerry jumps in. I'm sort of in agreement with you. I think it's good. Our stuff is good for like red flags, but banks are complicated, and so our stuff is fairly simple. So I think it can help point people in the right direction, but it'll be difficult to sort of tie specific legislation to it.
Actually, I was going to say something almost exactly in the red flags kind of spirit, which is there's this sort of dialogue which is very frustrating between academics will say market values, and then the regulators will say too many false positives, can't use them. Yeah, you wouldn't necessarily want to use them in a hard-coded rule, but they're very useful. It seems to me like if your stock is down 40%, there should be a default presumption that there could even be a rule that there's a default presumption that now the supervisors have to go back in and explain why, they're bound to explain why that 40% wasn't a concern. So you can use them in a way that doesn't, create a sort of mechanical problem with false positives. And I feel like the dialogue is often, somebody like Bob will say this, regulators will say this is really unrealistic, and we're done.
So just to be clear, that's not actually what I said.
I wasn't.
And that's not what Debbie asked. What Debbie asked is I recognize that they use them. What's the scope for hardwiring them?
But I've had this conversation many times.
Oh, sure,
okay. Could you do a better job with market values? And people will say, no, death spiral or some other terrible bad thing. And that's a caricature of, and I think Matt said it exactly right. There are a lot of ways you could sensibly use them as red flags without creating kind of mechanical problems.
So one of the things that I did at the Fed was I started the first financial stability section, and we spent a lot of time trying to figure out what should we do. One of the first things that we did was to prepare a list of the major institutions and real-time estimates of what their asset prices were, what their CDS spreads, so that we would have the capability to have those red flags when those things happened. And I know that there are similar forms that, at least when I was there, when I left, there are similar forms prepared for all the major institutions looking at their credit default swaps, looking at their equities, looking at other things that are provided with red number, that get red.
Right.
Well, that's the question.
More muscular supervision.
That's the question.
Yeah.
We have one from the virtual audience, which is, I think, a very quick one. What's the one policy change you would make to all this? So what's your top policy priority, either by reg or supervision policy, you would make? Is from the audience.
Not me.
This is totally unrealistic, but I would change bank accounting and make it closer to mark. One change. That's it. Good luck. Let's see. When are we going to get that?
I would have the Fed sell contingent collateralized lines of credit for fees to banks, and I would count the capacity to use those lines as a cash inflow and liquidity assessments. That's something that's in the international LCR standard, and it's in the rule for the LCR when the banking agency published in 2014 as a possibility.
I guess I would like cap and liquidity to be jointly linked when you're looking at it. I think it's looked separately a lot. It should be put together. But I agree with both of those other ones as well.
I think with that, we're time for a quick break. I will change the clock to make sure it's accurate, but why don't we take about a 7-minute break? And I want to first let's thank this panel for